The bull market is going to be celebrating its third anniversary this weekend, and joining us right now to talk about it is Carol Schleif. She is chief market strategist at BMO Private Wealth. Carol, you think that these all-time highs that we're watching, not only in the equities market, but also gold, is less anachronistic than it seems. What does that mean?
I mean, it would typically, gold is hitting highs when people are really worried about things, if you will. And so that piece makes some sense. The interesting thing is, though, is you would assume that there'd be, party down on Wall Street in terms of people very exuberant about the way things are going. But this has definitely been that wall of worry climb, the drudging up the hill, if you will, as we've come through this, and people are questioning things. And now you're getting more questioning. The segment you all were just talking about, that circular financing. We're starting to get some of that in the AI data centers and things like that. So investors are nervous, but not nervous enough to step off. So you've got, basically barbell portfolios for a lot of people where they've got some hedge in there, either in fixed income, gold. Some people are using Bitcoin for that, assuming that it's going to play like gold, even though you look at a chart on it and there's a lot more volatility there. So it doesn't necessarily form the plug that you would want. But people don't want to get off the equity train either.
Which of these rallies do you have more faith in? The fear rally in gold, or the optimistic ebullient market in stocks?
Well, the interesting thing is, it's hard to say I trust one versus I trust the other, because in this business, it's like saying I guarantee, and with none of that can you say. There's different reasons people are buying the different things. I would think as an investor, as a long-term investor, there are places to participate in the equity markets that maybe haven't run as much. It also makes sense, and the thing that we advise our clients all the time is to pay attention to what they're doing in their portfolios, particularly, and to practice portfolio hygiene, if you will, which is regular rebalancing. It's taking some of the gains off the table to that extent. It's looking, especially at this time of year, are you going to owe some taxes? Do you want to start pulling off of some of next year's spending? Pull some of that off the table, put it in fixed income, put it in cash, and have some sort of fallback, if you will, in the portfolio, so that you're playing more with house money than with having everything riding in the equity markets. But we're overweight stocks, modestly overweight stocks, leaning into the U.S., continue to lean into that growth story, and think there's a lot economically that will be pulled through to undergird not just the data center build, but more broadly the usage of that and other technologies as well, in terms of robotics and still the shift to the cloud. There's a lot going on. There's a lot going on in healthcare. There's a lot going on in energy. There's a lot going on in defense.
Carol, just going back to this, when you say portfolio hygiene, I think of Joe's donut-flavored body
glazed donut
that he was going to rub all over his body.
And deodorant.
And deodorant. But what I really wonder is, if we are seeing gold prices up, and a lot of that buying's been happening during European and Asian trading hours, and we know some of those central banks are kind of loading up with this, is this a situation where other countries are hedging their bets versus the dollar, versus the United States when it comes to our bonds? And is that something that could lead to bigger problems, but maybe further down the road? It's not something that's going to pop up immediately.
I think it's that gradual de-dollarization, if you will, where you had a lot of emphasis in the last number of years that was really focused on U.S. investments, because we're about the only game in town. You look at our GDP growth, the economy was growing, there was extra stimulus going into the economy, which was keeping things humming here for a lot longer than the rest of the world. Now at the margin, and I know when we talk to international investors as well, they're thinking, okay, with this next dollar or with this next unit of investment I have, do I really want to put it in more U.S. entities, or do I want to find other places to do it? And those central banks are buying. I think there's a movement at the edges, if you will, to hedge. And so we're big believers too that gradually over time it moves to an equalization, if you will, or a better equalization of global trade. Because when you look at U.S. stocks, what our percentage of global activity relative to the percentage of our GDP activity on the globe, there's a very big disconnect, and similar to other aspects. But for example, it's tough to take and transact in other currencies because the vast majority of transactions are denominated in dollars, whether or not it's an activity that's started or ended in the U.S. Transactions globally, over half of them are denominated in dollars. So it could easily be a gradual, not a sudden move, if you will, but we think that trend probably continues.